Today. Joining me today are esteemed panelists, Oyikonsola Aregbesola, who is the acting team lead, investment research at ARM Securities. She also covers the banking sector. Uh, we also have Muyosori Taiwo, investment research analyst covering the telecommunications sector, and Kalista Chileke, also an investment research analyst covering the consumer goods sector. We're also honored to have Rutimi Olubi, Managing Director of ARM Securities, and Kevin Olisidebe, Head of Institutional Sales, joining the discussion today. You're all welcome, everyone. So, before we begin, I encourage you all to actively participate. This webinar is not just about listening, it's about engaging. We want to hear your questions, thoughts, and perspectives. Please use the Q&A feature to submit your questions. I will do our best to address as many as we can during the intricate session. Now, I'll give the floor to our most esteemed Managing Director, Rotimi Olubi, for his welcome address. The floor is yours, sir.
Good morning, everyone. I'm most delighted to having us attend 2024 webinar tagged Making Smart Investment Choices in 2024. I'm Rotimi Olubi, as introduced. I'm the MD of ARM Securities. And on behalf of ARM, it's my pleasure to extend a warm welcome to all of you. In this fast evolving world, navigating the complexity of financial markets requires keen insights, strategic thinking, and a clear understanding of the ever-changing dynamics of the marketplace. Today, we have gathered some of our brightest minds in the industry to share their expertise and guide us through the intricacies of investing in the financial markets. If we look at 2023 marked a remarkable year in our markets. We saw that we saw the index from a standpoint of 51,595.66 points, appreciating to end the year 2023 at 74,733. Appreciating by over 45.9%. So if you are just a passive investor and if you have just invested in the index, your portfolio will have appreciated by over 45%. If you look at that performance of the index beats inflationary numbers for the year 2023. So you will have been better edged should you have even invested in the index. So for 2024, same optimism is being expected to continue. We expect to see a lot more volatile markets arising from events within the economy. We can see a lot of issues around currency, and then investors are looking at how best can they utilize their naira to take advantage of appreciable gains that outperforms the devaluation rates amidst increasing inflationary numbers. So I think the investment scape, both on the fixed income side and then the equity side, if well guided, one can actually make a combined return that would outperform inflationary numbers, as well as also the depreciation rate of our currency. So we have our best hands on the panel today that will take us through that. Take us through the knowledge that we need to have to better for our portfolios to better outperform those indices, those economic indices. So thank you very much. I expect us to enjoy our time today. And then should we have questions, I'll also be ready to also attend to some questions as maybe related to what I could attend to. But my team here on the call will also be ready to attend to most of our questions. Thank you very much, David, for the introduction. Thank you.
Thank you very much, sir, for that warm welcome. I can feel the excitement buzzing in the room already, and I know our audience are eager to dive into today's discussion. Now, over to our first panelist, Muyosori Taiwo, to kickstart the presentation. Muyosori, floor is yours.
Thank you, David, for the very warm welcome. Thank you, Rotimi, as well for that, very, strong introduction. My name is Moyo. I'm a telecom analyst, and today I'll be giving a summary of the outlook and our presentation before moving over to talk about the global markets, currency, crude oil markets, as well as the balance of payment position. So, on our outlook in our presentation consists of expectations of key macroeconomic variables like fiscal deficit, crude oil price, GDP growth, currency, inflation, and the monetary policy rate. The underlying expectations for our forecast, which will be shared in our individual presentations, however, as an overview, includes on this slide the 2024 fiscal deficit as proposed by the approved 2024 federal government budget, while that of crude oil price, currency, GDP covers our view within an average bear to bull case scenario for 2024. Our forecast listed, here on inflation is for December 2024, as you can see on the slide. And for the monetary policy rate, our projection is on the outcome for the first 6 months of 2024. Our views cover a range of factors which will be spoken to in subsequent slides. So now moving over to global markets. In H2 2023, we saw an interesting period to say the least. It was largely characterized by hawkish pauses by major central banks like the Federal Reserve, the Bank of England, and the European Central Bank for most of the period. During the latter 6 months of 2023, we saw the apex banks conclude on the necessity to continue reassessing the impact of previous rate hikes on their economy. This was in their bid to bring inflation down to their 2% target levels. And in Asia, although in Asia, despite the initial excitement from the Chinese economy reopening, we saw the impact of the property market slump weighing negatively on the Chinese economy as China flirted with deflationary pressures as consumer wallets were shut tight. In our view, we may see rate cuts sometime in 2024 in developed markets like the US, UK, and the EU, but we believe that these cuts may occur later into the year as inflation in some markets remains sticky in initial months in 2024, but progresses on a downward trajectory toward their 2% target levels. In China, we believe that the government will continue to inject liquidity and issue bonds to re-engineer its economy into a period of growth. However, we opine that large fiscal deficits will likely be limited by the expanding leverage levels in the economy. As you can see on this slide, according to its most recent global outlook, the IMF, or the International Monetary Fund, forecasts that the US is expected to grow by 2.1%, the EU by 0.9%, the UK by 0.6%, and China by 4.6% in 2024. Now, moving over to the crude oil markets. In early H2 2023, we saw the impact of a OPEC Plus voluntary cuts briefly move Brent prices above the $94 per barrel mark in September 2023, albeit majorly staying within the $70 to $90 per barrel range within those 6 months. In addition to the OPEC Plus cuts, we saw relatively low inventory levels from major producers like the US support this bullish run. However, toward the end of H2 2023, we saw global crude production pick up, and this was despite the additional 1.3 million barrel per day voluntary cuts from Russia and Saudi Arabia, as the increased production from non-OPEC Plus producers like Brazil, Ghana, US, and the US supported global supply. Consequently, in addition to weaker Chinese demand, the increased oil supply reversed the positive sentiment seen in earlier months in H2 2023 on oil prices, with investors betting that these supply factors would cause OPEC Plus cuts to be insufficient in driving a strong oil price rally. In H1 2024, we may continue to see we may see, volatility in oil prices as persistent volatility in oil prices as the impact of the announced OPEC Plus cuts, escalating geopolitical tensions in the Middle East will be partially offset by weaker Chinese demand and increasing non-OPEC Plus production. Our base case forecast for the Brent is $80 per barrel, while our bull case forecast stands at $95 per barrel. Now, moving over to the currency market. In H2 2023, we saw subdued capital inflows, depletion of external reserves, and increased demand for dollars as factors increasing the FX illiquidity in Nigeria. And relative to Q4 2021, FX reserves declined by 17.35% to $33.72 billion in Q3 2023. And this was despite oil prices hovering around the $90 per barrel price, and local crude production exceeding $1.3 million per barrel mark in September 2023, which was the highest recorded since January 2022 in Nigeria. We believe that the limited pass-through effect of high oil prices and improved production may likely reflect the now phased-out crude swap agreement, as we believe that obligations are still being fulfilled by the NNPC. As a result, since the FX liberalization in June 2023, the Naira at the official window depreciated by 46% in 2023 to 881.53 Naira per dollar, while in the parallel market it fell by 38% to 1,195 Naira per dollar by the end of the year 2023. In 2024, we expect to see a less volatile Naira, and this is on the back of improved liquidity from approximately $10 billion in inflows from both the proposed NLNG dividend securitization and the concluded Afrexim Bank loan. And this is despite unabating demand pressures from people. Also, last week, we saw the news of Ivory Coast closing an oversubscribed Eurobond issuance of $2.6 billion, and this breeds positive prospects that Nigeria may re-enter the international bond market before the end of the year 2024. We also expect to see increased FX proceeds from crude sales from the full-scale operation of the 650,000 barrel per day capacity Dangote refinery to support a stabilizing exchange rate. In addition, we believe that increased FX remittances, proceeds from the possible privatization of public assets, and additional crude production from the Port Harcourt oil refinery may also serve to support our positive outlook of a stabilizing exchange rate. From the angle of inflows, we expect lower global interest rates in 2024 to support increasing FPI inflows into emerging markets like Nigeria, and we believe that emerging market policy rates are likely to stay elevated, and this is underpinned by the persistent inflationary pressures within the region. Also, based on the recent policies from the CBN, we see the commitment of the Apex Bank to restore the interest rate transmission mechanism and engineer higher real rates to likely improve FPI inflows. On our updated forecast for the Naira at the official window, we expect that on an average basis, the Naira will close within a range of 950 to 1,000 Naira per USD in 2024. Now, looking at our balance of payments position, in Q3 2023, Nigeria recorded a positive trade surplus, making it 4 consecutive quarters where export value exceeded import value. And this can be attributed to the FX illiquidity locally during the period and a weaker Naira, which meant cheaper exports. we saw total trade increase by 2.93% on a quarter-on-quarter basis to 24.6 US dollar billion US dollars, and we expect that higher oil exports would support greater trade flows in Q4 2023. And this is the next data point to be released. Finally, the impact of a weaker naira is also likely to limit imports, which then underpins our view of a persisting trade surplus in H1 2024. Now, I will let my colleague Calista tell us more about domestic events, starting from capital importation. Calista.
Thank you, Moyo, and good afternoon, everyone. My name is Calista Chilike, and I'll be taking us through the next couple of sections, which include capital importation, GDP, inflation, and monetary policy. Starting first with capital importation. We've seen that capital importation into Nigeria has been on a steady decline since the second quarter of 2020. The initial plunge was triggered by the COVID-19 pandemic, and this prompted investors to seek safer havens in more advanced markets with lower risk and higher interest rates. Beyond the pandemic, that's afterwards, we saw that the persistent underlying structural inadequacies in Nigeria, such as insecurity, significant infrastructural gaps, foreign exchange illiquidity, and unstable monetary policies implemented by the CBN, all contributed to lower capital importation. We recognize the efforts that the current administration has put in place, such as the unification of FX windows, the scrapping of petrol subsidies, and the deregulation of the downstream oil sector. All this aimed at attracting foreign investment into the country. However, this has not yielded significant results yet. But moving into 2024, we might see some respite in FPI inflows on the back of the $10 billion FX inflows from Afreximbank and the NLNG dividend securitization, which could help improve dollar liquidity in the short term. Also, we've seen that the CBN has started clearing FX backlogs, and this could help reduce downward pressure on the exchange rate and improve FX liquidity. And finally, the relatively higher real rates, interest rates of Nigeria compared to other emerging markets may incentivize investors, that's foreign portfolio investors, to pull in their funds into Nigeria. Yes, we've seen some downgrades by rating agencies last year, like the FTSE Russell and MSCI index. But we believe that the recent CBN policies on banks' net open position and strategies, we could see renewed interest from FPI investors, potentially leading to more inflows. On the issue of FDI inflows, that's foreign direct investment, we believe that the prevailing structural challenges, such as insecurity, poor infrastructure and road networks, high inflation, and lower interest rates compared to global economies would further deter FDI inflows into Nigeria. Moving over to GDP, Q1 2023, that's the first quarter of 2023, was a somewhat peculiar period, marked by modest year-on-year growth of 2.31% compared to the 3.52% year-on-year growth recorded in Q4 2022. However, we saw that the Nigerian economy staged a recovery, demonstrating consecutive growth in both the second quarter of 2023, where it recorded 2.51% year-on-year, and Q3 2023, where it recorded 2.54% year-on-year. This resurgence, or should I say recovery of the economy, occurred against a backdrop of several macroeconomic challenges, such as the FX illiquidity, inflationary pressures, and high interest rates, compounded by persistent structural issues like insecurity, inadequate infrastructure, oil theft, and pipeline vandalism. We are quite optimistic about GDP growth in 2024. First, for the oil sector, we expect that higher crude oil production as the government punches down on oil theft and pipeline vandalism. However, it's important to note that with the new OPEC plus quota of 1.58 million barrels per day, this quota puts a limit on how much Nigeria can produce crude oil within the year. However, as Moyo has said, with our expectation of $80 per barrel for our base case and $95 per barrel for our bull case. We think that this increase in crude oil price might help to boost oil sector growth. We are similarly optimistic about the non-oil sector, as we believe that it's going to continue on the path of growth. And we believe that the growth in the oil sector will be spearheaded by the services sector, particularly the financial services and the ICT, that's the information communication technology subsectors. This is because we can see that the use of e-transactions has continued to be on the rise. And additionally, we anticipate a notable uptick in the agriculture and manufacturing sectors, fueled by a low base effect from 2023. But we recognize that issues such as elevated borrowing costs, high inflation rate, and FX challenges could stifle growth within these sectors. So overall, for 2024, we project that GDP growth will stay at 2.71% for the base case. And for our bear case, we project a GDP growth of 2.09%. And for our bull case, we project 3.24% GDP growth. And moving to inflation, in 2023, Nigeria experienced high levels of inflation, maintaining an upward trajectory throughout the entire period. And we all know that the price surge in H2 2023, that's the second half of 2023, was primarily attributed to the implementation of two pivotal policy reforms, which are the removal of PMS subsidy and the liberalization of the foreign exchange market. And back of all this, so that inflation ended the year at 28.92%. That's for December 2023. These changes that I'm referring to, the policy changes, compounded by structural challenges that I mentioned earlier, including inadequate rainfall, security issues in food producing regions, logistical hurdles, and insufficient storage facilities, all collectively contributed to inflationary pressures last year. In our forecast for inflation in 2024, we considered various factors, including the direction of fuel prices in the year, the level of naira depreciation, possible implementation of the postponed electricity tariffs. We recall that this was a major discussion in 2023 before it was eventually postponed. And we also considered the level of food supply, and as well as possible improvement in FX supply. In our base case, we forecast an average inflation rate of 24.39% in 2024 full year, and is based on a slight improvement in FX supply levels relative to 2023. We also envisage that exchange rates will be at 1,000 naira per dollar. We envisage an average PMS price of 615 naira per litre, and a possible 15% to 20% enforcement of electricity tariffs, as well as stable food supply. For our bull case scenario, we consider significant improvement in FX supply levels, currency appreciation to about 800 naira per dollar to 950 naira per dollar, an average PMS price of 600 naira per litre, no enforcement of the electricity tariffs, and increased food supply. So we, on back of this, our bull case scenario forecast an average inflation rate of 23.51% in 2024. Finally, our bear case scenario anticipates that the FX supply will worsen. Naira will stay above 1,000 naira per dollar. Average PMS price will be around 800 naira per litre, and the postponed 40% electricity tariff will be implemented, and food supply will worsen. On the back of all this, we see the average inflation rate for 2024 in our bear case scenario reaching 25.76%. So overall, for our base case scenario, we expect that headline inflation will settle at 21% by December 2024. For our monetary policy in 2023, there were significant developments that unfolded at the CBN. We saw a change in leadership, as well as the release of the bank's financial statement. A total of 4 MPC meetings were held during the year, where the interest rate was hiked up to 18.75%. We also saw that the asymmetric corridor was increased to plus 100 and minus 300 basis points around the monetary policy rate, while the cash reserve ratio was kept at 32.50%, same as the liquidity ratio, which was kept at 30%. Nigeria's inflation has proven to be a resultant effect of both supply and demand factors. And the CBN focused on curbing the demand side issues, particularly excess liquidity in the second half of last year. And we expect that this effort will continue into H1 2024. And we expect that the CBN will continue with its tightening cycle and hike the monetary policy rate by about 300 basis points in H1 2024. We also expect the committee to make use of other monetary policy tightening measures beyond the MPR to curb inflationary pressures. I will now hand over to my colleague Oyin Consola to take us through fiscal policy, a review of the capital markets and strategies we as investors could employ to maximize our investment returns in 2024. Thank you.
Thank you, Calista, for that presentation. So I'll continue from fiscal policy. So looking at the implementation reports as released by the Budget Office, we saw that the 9 months prorated aggregate revenue for FGN, outperformed the prorated budget by about 4.46% at 8.65 trillion. And the reason for the outperformance was as a result of impressive non-oil revenue, which surpassed the budget by about 35.05%, riding on the wheels of increased company income tax collection due to improved corporate performance and slightly higher VAT revenue. Looking at the oil revenue, we saw that although oil price averaged $84.74 per barrel in the 9 months period in 2023, we observed that oil revenue remained underwater due to lower oil production, which settled at 1.45 million barrels per day versus the budgeted 1.69 million barrels per day. Consequently, we saw that oil revenue in the period underperformed by 15.3% at 1.42 trillion. Elsewhere, looking at the expenditure leg, we saw that a supplementary budget of 2.18 trillion was passed in Q4 2023, which brought the total 2023 full year budget to 24.82 trillion. Consequently, the government spent 31.8% less than the budgeted expenditure in the 9-month period. This was basically an offshoot of shortfall in capital expenditure, which was short by about 75.3%, and non-debt recurrent expenditure, which fell short of budget by 31.4%. And on the flip side, we saw that more was spent on debt servicing, which was more than budgeted by 17.7%, basically largely underpinned by higher domestic debt and interest on ways and means. Looking at the 2024 budget, you can see on the right side of our screen, government has put forth a 28.66 trillion budget for 2024. And looking at total revenue is set as 19.52 trillion. Versus the revised 2023 budget of 11.05 trillion. And basically, this revenue projection is premised on oil production volume of 1.78 million barrels per day, oil price of $77.96, and average inflation rate of 21.40%, and an average exchange rate of 800 naira to $1. Now, looking for our own opinion, although the removal of fuel subsidy as well as the devaluation of naira should actually help up prop revenue, we still do not expect FG's realization of its oil revenue estimates. But in terms of non-oil revenue, we are quite confident of the government posting a decent performance on the back of higher company income tax, feeding from solid corporate performance and effective tax collection in 2024. overall, while we foresee expanding debt levels in 2024, we expect to see a moderation in the use of ways and means financing and increased focus on domestic borrowings. I mean, we're already seeing that play out, in the debt market. Now, over to the fixed income market. In 2023, we see that that is in the second half of the year, we saw that yields moved higher by 55 basis points, specifically in the NT bills market. In the secondary market, average NT bills yield decreased by 6 basis points, while average bond yield increased by 115 basis points. In the primary market, we saw that average bond yield rose by 319 basis points to 16.29% in the second half of the year. And for the NT bills space, in the primary market, we witnessed average stop rate rising to 8.84% as compared to 7.56% recorded in the first half of the year. Now, in August 2023, the CBN resumed their previously suspended open market operation sales. Stop rates on the long end of the curve averaged 16.24%, with strong demand, underscored by an average risk cover ratio of 3.06 times across all auctions. This basically, reflects the bank's reversion to policy orthodoxy, exemplifying their intent to attract, foreign investments through high nominal rates. Now, for our outlook, while we expect liquidity to remain elevated, we find that the CBN would significantly mop up, liquidity gluts in the system in the effort to rein in the price uptrend. Overall, we believe that, yields are likely to remain on the upside, assuming that the CBN, maintain their inflation targeting policy framework. Now, moving on to the equities market. In 2023, for the fourth consecutive year running, we saw that the Nigerian equities market closed the year positive with a return of 45.9%. Basically, major policy reforms, spurred positive sentiment in the market, despite global rating agencies' downgrades and macroeconomic challenges. Now, the stronger performance is not exactly far-fetched, seeing that domestic investors accounted for about 88.78% as of November 2023. Now, looking at the sectoral performances, we can see the chart on the left side of the screen. You can see that the oil and gas sector, led sectoral gains with a 125.54% year-to-date returns, followed by banking, which gained 114.9%. The consumer goods sector gained 90.39%. The insurance sector gained 84.48%, while the industrial goods sector gained 12.86%. Now, for the oil and gas sector, we note that reforms in the downstream sector actually spurred positive sentiment along that line, and we believe that the sector will continue to grow this year with our expectation of higher crude oil production and the optimism around the commencement of the Dangote refinery. Now, however, a risk to our outlook is persistent insecurity, which we've already seen play out last month, and then the crude oil thefts, FX illiquidity, poor infrastructure, and volatility in crude oil prices. Now, for the banking sector, the impressive performance that we witnessed last year was basically driven by substantial FX revaluation gains. Now, looking ahead to 2024, we anticipate the normalization of the FX revaluation gains. I mean, we've already seen CBN, different circulars, from the CBN, especially the one addressing the net open positions of banks. However, we still expect increased interest income due to elevated interest rate environment. Now, for the consumer goods sector, we expect to see some level of growth in revenue. I mean, primarily driven by companies resulting to price increases to counter inflationary pressures. However, we acknowledge the potential for higher cost pressures due to FX illiquidity, and which could actually pose challenges to the sector. Now, for the insurance sector, we expect to see a continued upward trajectory in the sector, driven by sustained growth in earnings. Lastly, for the industrial goods sector, we expect more substantial returns, driven by increased demand by both the public and private sector. I mean, last year was basically an election year, and then we saw we saw projects being paused, and we expect to see resumption of that, and as well as commencement of new ones. So that should definitely drive demand in that sector. Now over to our capital market strategy for 2024, specifically for the first half of the year. For the equities market, we note that several factors such as corporate performance, direction of fixed income yields, government policies, investors hunt for dividend, as well as exchange rate volatility would affect the space. We're already seeing release from different companies, the release of their 2023 full year financial statement, and we already see that play out in how some of these stock on the exchange are already performing, and of course expectation of investors in terms of dividend payments would also drive sentiment along that line. Overall, for our sector recommendation, we advise investors to focus on high dividend paying stocks with good fundamentals in sectors such as the industrial goods sector, oil and gas sector, as well as the banking sector. Now, moving on to our fixed income market strategy for the first half of the year. So for our expectation, we actually expect a bear flattening yield curve in H1 2024. What do I mean? We expect yields on short-term instruments to rise faster than longer dated instruments. So as the CBN maintained their hiking campaign to bring down inflation to acceptable levels. So we expect that the yield trajectory would, of course, be determined by the MPR direction, inflation rates, as well as financial system liquidity. I mean, my colleague Calista already gave us our expectation for MPR direction in first half of the year, as well as inflation level. Overall, we advise investors to maintain a short position at the near end of the curve and consider locking in high returns from money market instruments. Now, a weeks to outlook is a scenario where the CBN reverts to unorthodox monetary policies, and we see a further divergence in monetary and fiscal policies. Thank you. Over to you, David. Thanks.
Okay, thank you very much to our esteemed panelists for such insightful discussions. We now open the floor to your questions. Feel free to type your questions in the Q&A or chat box. We'll attend to as many as possible. But just before we dive into our Q&A session, let's take a moment to gather some insights from all of you. We have a couple of poll questions prepared to gauge your thoughts. Your participation will help enrich our discussion. So let's get started. So the poll is still going on. Please leave your comments. Make sure you participate. The poll will be ending in 30 seconds. Okay, so we've come to the end of that session. Thank you very much for your participation. We'll just jump right ahead and get to our Q&A. We'll take your questions now. Okay, so going ahead with our Q&A questions. So our first question, it says, how will global events like geopolitical tensions So our first question says, how will global events like geopolitical tensions, inflation, and interest rates fluctuations impact the Nigerian markets? Um, I think our panelists, Muyo, Sori, Taiwo, would be happy to attend to that question.
Okay, so said how would global, sorry, just give me a second.
Sorry, let me take the question again. The question says, how will um, global events like inflation, geopolitical tensions, and interest rates affect the Nigerian markets?
Sorry, I was on mute. So thank you for that
Yeah,
question.
sorry, no.
So global events such as geopolitical tensions, inflation fluctuations, and changes in interest rates, would always, affect the Nigerian market. And Nigeria being a major oil producer and exporter, our economy is particularly vulnerable to disruptions in the global oil markets. So when we have, geopolitical tensions, in an event where prices skyrocket, right, we benefit from recording higher export proceeds. But when we have like a situation in 2020 where we had very low oil prices, right, it means our proceeds, our revenue proceeds would also be low, and that affects government revenue, foreign exchange reserves, as well as investment prospects, right? So investors, look at this as, our revenue coffers are likely to be low. So, why, would they bring their money when, they believe that, you will not be earning as much, to pay back, on possible obligations. So, if going to inflation, inflation, is also influenced by, movements in global commodity prices, also disruptions in local supply chains as well, that which we are currently seeing in Nigeria, where we have issues of insecurity, logistic issues, infrastructural challenges, affecting domestic prices or food prices, right? And shifting global interest rates can also affect capital flows into and out of Nigeria, and this would definitely lead to a currency depreciation or appreciation depending on where the movement is going and current investor sentiment. So I'll just say that Nigeria's market is closely intertwined with global dynamics, and this necessitates vigilance monitoring and policies geared to adapt to navigate the potential impact of these factors.
Thank you very much for that answer. We're sorry. Okay, so our next question. Okay, for our next question, it says, how can one invest into the NGX index through ARM? How can one invest into the NGX index through ARM? Uh, Kalista Chilike, I don't know if you're happy to take this question.
All right. Thank you, David. I think first of all, you have to speak with our staff, right? So there's an ARM stock trade account. You can download that online, and then you can also reach out to us, and then we can help you set it up. So the NGX index is the equities market basically. So we can help you set that up. That's all.
Thank you very much. Okay, for the next question, So our next question is, so somebody said, but there was one reiterated point in all the presentations: bad infrastructure, security, and poor logistics are all underlying causes of stifled growth or regulations. Sorry, I think I lost that question. So let's just take another one. Can the Dangote refinery play a significant role in reducing pump price? How efficient will it be, and what impact might it have on the broader economy? Uh, can one of our panelists take these questions? Maybe Moyo Story Taiwo again.
Okay, and thanks for that question. So I think the Dangote refinery would definitely help in reducing, pump prices, as you know when we have these refined crude products sold to the downstream market, it would increase the supply, the availability of refined crude products like PMS, which is petrol or diesel prices. And we know that the dynamics of demand and supply. So when we have increased supply, typically what happens is it breeds competition, and people begin to offer to undercut competitors, right? And which then leads to lower prices. It also helps through so when we have increased production, right, and it would reduce the need to import. Currently we know how much we import. We import mostly all of the our refined crude products used in a domestic basis. So the coming on board of the 650,000 barrel per day refinery would then be able to meet most of the needs locally, with some left for exports.
Thank you very much, Moyo. Thank you for. So this question says, what are the potential economic and financial implications for Nigerian investors and the Nigerian capital markets in the event of a successful withdrawal of Mali, Nigeria, and Burkina Faso from the Economic Community of West African States? Oyin Consola, would you like to answer this question, please?
Thank you. Please, can you repeat the question?
What are the potential economic and financial implications for Nigerian investors and the Nigerian capital markets in the event of a successful withdrawal of Mali, Niger, and Burkina Faso from the Economic Community of West African States?
Okay, thank you. So, I mean, in addition to increased security risks, obviously, and we know that trade flows would likely be affected. And although official data shows relatively insignificant flows, unofficial trade is likely to be significant. Also, these countries are also major export destinations for industrial companies like cement producers, and the prospective commercialization of the Dangote refinery would likely support exports to these countries. Upon the exit from ECOWAS, it would then mean it will become more challenging to trade with these countries. Also, the ease of transfer of skills and resources between ECOWAS countries would be impeded as smooth entry and exit between these countries and ECOWAS would likely be restricted. Also, risk premiums across the neighboring regions may likely increase as investors price in the heightened risks of similar military interventions, of which is often associated with arbitrariness or lack of fairness in policy making, and the absence of an independent judicial legislation. I just want to correct something earlier. So in terms of reaching out to in terms of investing with ARM, rather download the ARM One app, not the stock trade, because we have all the offerings all in one app, which is called ARM One app. So please can go over to your Google Play or your Apple store and download ARM One, so um, um, you can actually invest using that app, or better still, you can send an email to our securities team. We are going to share the email address with everyone after the presentation. Thanks.
Thank you very much, Consola, for that. Our next question is, what is the effect of inflation on fixed income investment? What is the effect of inflation on fixed income investments? Uh, Maybe Kalista, do you want to take this again?
All right. So what's the effect of inflation on fixed income investment?
Investments.
Rising consumer prices, that's inflation, has negative effects on our purchasing power as consumers, and it to serve as a motivation, or is to propel investors to ask for higher interest rates on their investment so that they can narrow the real interest rates. So stop rates on fixed income instruments will also increase. So overall, I'm just saying that increased inflation would decrease consumer purchasing power, making them to demand for higher interest rates on their investments. And we'll see that stop rates on fixed income instruments during auctions will be on the rise too. So
Thank you very much, Kalista. Okay. So another question here. Uh, this question says, what type of investments can I subscribe to that would likely beat inflation rates this year? This question says, what type of investments can I invest in that will likely beat inflation rates this year? Consola, please would you like to take that?
Okay, thank you, David. So, for investment, I mean, it basically depends on the risk appetite of the investor. That's the number one thing that you need to realize as an investor. You need to know your risk appetite, because basically what would beat inflation inflation at 28 plus percent as of December, is basically investing in the equities markets. And we saw that the Nigerian All Share Index gained 45.9% last year, and I mean our expectation, for this year is for although we expect mixed sentiments in the space this year, we still expect some good return. So basically, one of the investments that such person can look into is the equities market. However, it will basically your risk appetite is very important in making such decisions. So if you have a very low appetite for risks, I mean, it simply means that you want to lean more to money market instruments, or money market funds, or fixed income securities. There are no one way answer to this, but I'll say that means basically depending on your risk appetite. But if you are a high risk investor, you can look into investing in the equities market this year to stay above inflation. And you can again reach out to us for more specific advice. Thank you.
Thank you very much, Consola. So this question was directed to Moyo Sori directly. and it says, thank you for your presentation. Your 2024 currency forecast in the official window is 950 to 1000. Sorry, give me a second. Sorry, so I'll take it again. Thank you for your presentation. Your 2024 currency forecast in the official window is 950 to 1000 naira to a dollar. But presently, this is already well above 1000 to a dollar. What impact will this have on the long run? Oh, sorry, this question was directed to you.
Okay, thanks for that question. So I think, the rates which we're currently seeing now, we would say it's largely driven by, speculative demand, right? Because we're not seeing, and while we're seeing those rates, we're not seeing enough liquidity, at those levels to substantiate the fact that, that's where the naira should actually trade. And like I mentioned during my presentation, we expect to see some stability in the naira, and this would likely be premised on improved liquidity. With the pressures on the naira we're currently seeing is mostly coming from a supply dearth. That's lack of FX supply, and we expect that inflows from the expected 7 billion from the NLNG securitization, as well as the concluded Afrexim Bank loan to support. And also, like I mentioned in my presentation, we saw Ivory Coast, issue a 2.6 billion US dollar Eurobond issuance, which was oversubscribed, by the way. Probably the largest oversubscription from any African country. So we believe that the foreign market is well, positioned to receive, African issuances, right? And in the event that Nigeria, goes into the international bond market to raise, dollar-denominated funds, that would also provide some respite. Um, in addition, we also, see, plans from the federal government to, privatize some of their public assets. We see the Dangote refinery, 650,000 barrel per day. If we have a 70 to, you know, 85% capacity utilization, right? We expect to see improved crude supply and crude exports rather, and improved FX proceeds as a result of that export. And we also mentioned our oil price projection ranging from 80 to 95 US dollar per barrel, and in the event that our forecast, our detailed forecasts are realized, we'll see improved revenue coming from improved production, from curbing oil thefts, and exporting at higher oil production at these prices. And lastly, looking at the interest rate environment, we see, where the primary rate options have been closing, they've been closing relatively higher, and we also see, the recent policies from the CBN on the net open position of banks, which we also expect to improve, the supply in the short to medium term. So really, that all these factors, would support that supply leg, which would help stabilize the exchange rates.
Thank you for such apt response, sorry, Tyree. Okay, so another question is, so next question, I think Calista can take this for us. Question says, would you advise that one invest in stocks now, considering how bullish the market has been recently? Maybe Kalista Chiliki can take that question for us.
All right. First of all, we have to know that the bullish the bullish sentiment from last year entered into 2024. I would say that last year the equities markets performed exceedingly well despite saw downgrades last year. We also saw um the FX liberalization policy and the PMS subsidy removal. So despite all that, we saw that last year the equities market still performed positively. But this year we think that various factors will affect the performance of the equities market. We see that corporate earnings results, they are started coming in. 2023 full year earnings results have started coming in. We'll also see the direction of the fixed income market will also affect the equities market. So if fixed income yields are high, which we have seen currently, the fixed income market is actually bearish at the moment. We might see some bearish sentiment in the equities space. And as I said earlier, the release of corporate earnings results will also have a significant impact on the equities market. We have seen some companies release their earnings reports recently, and that is telling on the equities market at the moment. So will come together to affect the performance of the equities market in 2024. We'll also see some corporate actions. We'll see merger between Dang Sugar, Nascon, and Dangote Rice. We're also hearing that NNPC will enter into the equity, will be listed, as well as Dangote Refinery. So all these will culminate into um affecting the performance of the equities market in 2024. So it's important that before you invest, it's important that you seek advice from your research analyst like us, right? So that will provide you with the adequate information that you need before you enter into the market. Yeah.
Okay, thank you very much, Kalista. That was quite insightful. I hope he answers the question. So I will take another question from here. Income, please, you take this question. What are the options for investing in foreign currency? For example, in pounds. Can someone kindly, okay, this person is asking for direct conversation, but maybe you can just answer what are the options for investing in foreign currency?
I think Moyo can take that for currency.
Okay, so I think I was already responded to that. So we have at ARM, we currently have a Eurobond fund with a minimum of $1,000 investment, a minimum of $1,000 in subscription. So you can download our ARM One app to get to know more about that, or you can contact us, to follow up, and we can assist you.
Thank you very much, Moyo. Okay, so I think we'll take just a few more questions. This person says, what are the various investment products available at ARM? When Consola, do you want to take that?
All right, thank you. So, we've mentioned, we trade in stocks. There's an option to invest in equities, and as well as money market fund. We also have dollar investment as well. But you can actually contact us, so that we would know the specific investment you would like to invest in, and as well as advice. You can see our email address being shared on the screen. And yeah, so basically there are different investment options, and it's not even limited to. We also do alternative investment. We buy into real estate as well. So yeah, there are several investment options that you can um, that you can choose. So you can just reach out to us via the email that we've provided, or you visit our website at ARM, or you can also engage us on social media at ARM Engage, and we'll be happy to assist you. Thank you.
Thank you very much, Consola. And due to time constraints, we would have to uh, take our closing remarks. So we invite Kevin Olisidebe to give us his closing remarks. You have the floor, sir.
Thank you, David. Please, Professor, you can hear me.
Yes, we can hear you. Please go ahead.
All right, thank you, David, and thank you to the panelists. Good afternoon, everyone. I want to appreciate everyone on this call. At some point, I saw over 170 attendees, which is quite encouraging. I really do not take your attendance for granted. It's been a pleasure to have you in attendance on the call today. My name is Kelvin Olisedebe. I'm the head institutional sales and trading at ARM Securities. And on behalf of the entire team, I want to extend our gratitude to each and every one of us who attended this webinar. You would agree with us that during this session, we've been equipped with intelligent investment advice, and also armed with information to help us navigate this fiscal financial year, both on the global and in the domestic landscape. I want to sincerely appreciate our esteemed panelists for providing insights on how we can navigate the financial landscape in this current financial year. It is important to note that at ARM Securities, we continually provide for the needs of our clients across their entire life cycle. You know, with our businesses across, we have stockbroking, we have trusteeship, we have asset management, we also have financial advisory. Also, we are also into housing infrastructure and agri businesses. So, whatever may be your investment needs, you can be assured that ARM got you covered, right? Finally, I want to say that this conversation should not end here. You can also engage us on our socials for more information and updates on how to mutually take up this leadership in next level. Thank you once again for attending this webinar, and I hope we all have a good and productive day ahead. Thank you.
Thank you very much. Thank you very much, Kevin. And thank you to the entire audience for sticking around till the end. So don't forget to follow ARM on all social media platforms. And in case you have any further questions, or you feel like your questions were not attended to as well as you would have wanted, feel free to reach out to any of the panelists, or reach out to us at ARM. Also, the panelists are on LinkedIn, so you can send them a DM and they will be happy to respond. On that note, this brings this webinar to a close. Do have a productive day. Thank you.